Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Sheldon McIntyre on the line. He is the founder of 360 Virtual Advisor. How you doing on this Wednesday, Sheldon?
I'm doing okay. Yourself, Joel?
These markets are definitely interesting and keeping it exciting. Get things started off here. Tell us a little bit about 360 Virtual Advisor.
Sure. It's essentially an advisory service that I run through the MarketFi platform there with Benzinga. I offer trade recommendations on a daily basis, both pre-market and during the trading day. I have a kind of a daily summary where I go over some recommendations. I go over the tracking portfolio, which is also part of the service, and the general markets. And then on the weekends, I publish a sort of a weekly strategy fact sheet where I look at the my working thesis both for the U.S. market and in global markets in general, and any trading opportunities that might be emerging as I see it on Sunday.
Okay, so let's get to your thesis, Sheldon. I know you've been a bit bullish majority of the time on the way up here. We had that long consolidation period near all-time highs. Did you were you able to flatten out a little bit here before this big decline, or how were you sitting? Really, there we had that one Friday where we kind of fell out of bed and broke out of the bottom of the range and continued. How are you sitting on that, and what are you looking at going forward?
No, I was personally positioned as well as in the service. We were definitely net short coming into this week, and we were net short for 2 or 3 weeks actually ahead of this minor event that's taken place in the markets. For me, it wasn't really a surprise, both from a macro perspective or from a micro perspective. I had been articulating to the clients, but also through a couple of posts at See It Market that the macro momentum had been waning, and the market was due for a notable decline. And what kind of on the micro level was if you take a look after the I guess the closing high, which was back in May, there was clear 6 attempts to rally back above the 50-day moving average for the S&P 500, and each one of those failed. So that was a major warning sign. Usually when you get 4 or 5 failed rallies above the 50-day, particularly when you're sitting there in a market that the macro momentum is waning, you should be very cautious with regards to positioning to the long side, and that's exactly what we did.
And what do you use to come up with your macro thesis?
Well, one of the things, really, I have two models, but one of them that was pretty important that's worked, that has a better or a longer term cycle is what Walter Deemer calls the 4 year cycle low. And this particular situation, we should have been looking for a 4 year cycle low in 2013. And we've obviously continued to move in the market, creating what he calls a bull market extension. And this would have be number four since 1949. In the previous three, it plays out that there was the crash of 1962, there was the crash of 1987 that followed, and then of course we had bull market extension number three, which resolved to the downside in 2008, 2009. So in the previous three cases, you will note that we had two sort of like flash crashes, which were in 1962 and 87, and then we had the major kind of a secular bull market reset and in 2008, 2009.
And now looking at the market here, are you sizing up your buy list and looking for issues to purchase on the decline, or are you more looking to get some pops in some stocks and find some areas to short?
Well, like I said, we came into Monday net short, and I basically covered a lot of the shorts that we had. We had shorts in the emerging markets was our main area of focus as well. We were along the yen and a couple other U.S. stocks. I covered the majority of those positions right off the hop on Monday. It was clear that we were going to get some kind of bounce back right up. The price action dictated that in the pre-market that we were going to get some kind of snapback. So I took advantage of those prices off the hop and went to pretty much 100% cash position. But then yesterday I started adding back on to the emerging market equity complex. and adding more to the emerging market debt complex in terms of a short position. I still think that there's some major downside to be captured in the emerging market debt denominated in U.S. dollars. And so I'm positioned short in the emerging markets, and I might today, we'll see how things trade and play out. I might add to the short in the emerging market equity complex.
So you're just not, you just don't think this is, you got to buy the rip. You had two dips under 1900, 1851, 1831 was a low on Monday, 1860 the low yesterday, 1850 pre-market trading. You still think you're gonna get a chance to purchase some things back under 1900 in the S&Ps?
Oh, definitely. I think so. I one of my macro thesis projections for the S&P has been now since the end of last year is that we would see a test of the 200-week simple moving average on the S&P, and that comes in about 1707 right now as it reads on my chart, which is not much of a decline from yesterday's close, but about 8.5%. It would be about a 20% decline from the May best closing level for the index. So I do see that happening. It's something to keep in mind. And it's maybe anecdotal, but as of yesterday or as of Monday, really according to Bank of America's research, the average intra-year decline during a secular bull market is only 11.5%, and we pretty much hit that spot on Monday and again yesterday. So I see us, having a little bit more downside. And if you take a look at some of the more, I would say, crash-like events that we've seen in the S&P, like if you take a look at 1987, you look at 98 or 2011, even 2008, 2009, usually what happens is you establish a momentum low. That's when everything washes out. You can see it on whether it's your breadth metrics, your sentiment metrics, etc. And then there's some kind of, I won't call it consolidation really, but sideways action that's highly volatile that is really good for day traders and short-term traders, and then you establish a price low, and that's what you saw in 87. In October you had the momentum low, and that was followed by a price low in November. And 1998 you saw a similar thing where you had the momentum low in August thanks to Russia, and then the price low which was associated with LTCM. And then you can go out to even 2002, you saw it, and in 2011, you had a momentum low in August, followed by the price low in October. And I would suspect that if we haven't established momentum low, which I don't think so yet, it'll be relatively soon, and then we should see a price low develop, in maybe 6 to 8 weeks following.
You alluded to it in your earlier comment here, but Rob Hood is in the chat and he asked for an update to the SPX chart pertaining to the average intra-year pullback, 11.5%. And does this current environment put the year 5 data in jeopardy?
That's interesting. That's one of the things that I've been tracking really since the beginning of this year was, how this year, based upon pre-statistics for, pre-election year, et cetera, we were looking for a pretty bullish year, but the targets that were associated with past percentage gains in those years, we were not achieving them. And that was a yellow flag, I would say. That's more anecdotal and on the periphery. But I would say that, yes, those are in jeopardy, definitely.
Okay, all right, and you gotta figure China into this equation. If there's a slowdown in China, big trading partner, big consumption. I mean, do you look at this as being something cyclical and could really cause a bear market or depression? I mean, we got through the Greek crisis, and now we're all worried. Things are going on in China. I mean, what's your outlook on China?
Well, my view on China has been pretty much standard for a few years now. It's in a secular, I guess some people would argue that it's not, but I view the market itself as a secular bear, and we're reverting back down. I told my clients right after the measures that were taken the end of June, early July, that China was going to find out the hard lesson that putting together piecemeal reforms or ways to stop or halt market declines were not going to work, and and that markets always win in that scenario. And this was one of the first times China's had to deal with that reality. And I projected that we would test those lows that we saw, and obviously we have now in the last few trading days. In terms of China itself, look, I've kind of classified, China, Brazil, Indonesia, Chile as emerged markets rather than emerging markets now. And with that comes new responsibilities and new pressures on their countries. And we're seeing it play out not only in China but also Brazil, Chile, where I live, even, which is the largest exporter of copper. And really, China has always been sort of a market. I remember when I started getting into the business in '97, is that it has a tendency to run up really fast and fall as quickly on the downside. So, what has taken place there is not a surprise, and I don't see any depression coming for the United States. This is simply potentially a cyclical bear market that's probably will be resolved rather quickly, and we'll march higher from here. I'm not concerned about those issues at all. We'll start to see a positive divergence from the developed markets in the coming days and weeks from what's taking place there.
Rob Hood in the chat wants your thoughts on, I believe it's Ubiquity Networks Incorporated. I mean, here's a stock kind of hanging out still near the highs of the move. I mean, some great daily resistance here for Rob Hood. 3403, that's where we're trading. I see a trio of actually 4 out of the last 5 highs, Rob Hood, between 34.59 and 34.74, 70 cents away from there. I'm surprised it's not trading up in the pre-mark, but that's a huge level. Any thoughts on UBNT?
Well, relative to the majority of the charts that I've been looking at, it doesn't look so bad. It looked like it's trying to hold the 10-week simple moving average here. It's getting some volume, but there's an old saying, something along the lines that when they raid the cookie jar, they usually take everything. And at this point, I'm not sure that I would be trying to pick a stock that's coming off major lows. I guess was in February and May were the major lows for this stock. Personally, I would not trade this stock. I'd be looking for ones that are actually displaying strong relative strength at or near important 52-week highs.
Okay, and moving on, let's just touch on a couple big issues here. Apple got the $92 on Monday. Any thoughts on Apple?
Well, did you get any of that, Joel?
No, I didn't. I didn't. I wish I would have.
I put some offers out there, but the prices at those levels were quick that the average market participant I don't think got any. But Apple came down to that key level that we saw in 2012, and see here that 86.70 is the 200 week. I would not be surprised if that's tested if the market continues to trade weak. That would just simply be another bull market reset for the stock. If it trades down to that level, I'll be trying to buy some at that point.
86.70, really, Sheldon? That's $20 away from here.
Yeah.
Yeah, I mean, I don't know. I mean, I mean, some people would think that would, we'd need like a market crash to get Apple down another $20.
I don't know. I think that there's a lot of overhead resistance has been established in a lot of stocks here now, and people that were lucky enough to get in near those lows on Monday, will be looking to take those profits. I think for the same reason you're saying. I mean, they picked up a 10-point move or more in that time. But if it gets back down to that low on Monday, or close to 86.70, I would be looking to definitely be backing up the truck and loading up on that stock.
Wow, picking a long-term level and sticking to it. Just let's touch briefly on the crude oil market there. Now we are under $40 here. Low of the move. Let's see what the low of the move here is in crude. I believe it's in the 38 handle, and it's 38.16. Or no, excuse me, 37.75. That was the low on Monday. Any chance for a rally in the oil patch?
I do think so. Yes. The important level for crude, like crude oil, is 41.15, which was the 1990 high. And if you go back and look at the chart, long-term chart, you'll see that back in 2008, 2009, we had monthly swings that went below that price level, but never on a closing basis, monthly closing basis, we didn't see it close below that level, and also coincided with the 200-month simple moving average. I think this is a price low, which I was talking about with the S&P 500. We saw the momentum low earlier this year, and I think now we're established. We'll be, trying to set up a price low here in the coming days and weeks. I would be surprised if we crash below the 2009 high at this point.
Okay, and what about gold here? I mean, you think chaos in the markets. You kind of got your rally before gold, but kind of throwing it out now with the rest of the market. Got up to nearly 1170 here. You looking to buy gold here on a pullback?
I actually bought some when it was down near the lows a couple of weeks ago. I also bought the gold miners. I closed those trades though. I still think that $1,000 might play a magnet effect and pull the price back down to test that low. But seeing it go much below 1,000 would be tough for me to see at this point. We're entering the period pretty close here to important gold cycle developed by the Aden sisters, and I think probably by the fourth quarter we should see an important price low for gold. And I if it develops below 1,000, it wouldn't be much more than 900, I think.
Okay, and just we got about a minute left here. Just final words of advice. You're having a lot of caution here, and I like to hear what you're saying. Just any final words of advice for, let's say, for longer term investors.
Well, first of all, I think, stay away from listening. If you are a longer-term investor, I think, don't get caught up in the high-fiving of people that are capturing some nice gains on an intraday basis in these swings. They obviously are skilled at it. You don't, definitely at this point in time, you don't want to get into style drift and start trying to do what you normally don't do. Look for your levels. Maybe talk to somebody that has some experience with technical analysis. Establish your levels and use those to add to your positions. But this is not a time to sell. I'm not always someone who says that. I never said that in 2008 or 2007. But this is not. I believe we're in a secular bull, and this is a chance for you to use some correction or bear market price levels in quality stocks to buy and continue with this secular bull.
Okay, we've been on the line with Sheldon McIntyre. He's the founder of 360 Virtual Advisor, sharing his thoughts on the volatile market. Thanks a lot, Sheldon. I always enjoy you being in the chat room. I think you were there on Monday when we were going over that open. I hope it helped you in your trading.
Yes, thank you, Joel, and thanks for having me.
All right.